I wish there was a good way to transition into the next topic, uh, but there isn't one right now. We're going from AI, Fannie and Freddie with Palantir to the bond market. Um, so another thing that happened this week, or that's been happening lately, is the failure of the U.S. bond market. If you didn't know already, the U.S. government has auctions to sell bonds. The way that they attract investors is using something called a yield or an interest rate, right? So a yield gives whoever buys this bond, this like ticket, whatever, a guaranteed amount of return. And the higher the percentage or the yield, the higher the return. So uh, the most recent auction was done, I think, a few days ago on 6/2, and it was a 20-year bond, and the yield was 5%, a little bit over 5%. But the previous one was a 30-year note, but the yield was lower. So what is a big deal? Well, when the shorter term bond yield is higher than the longer term bond yield, that's called an inversion. And usually when an inversion happens, it's kind of a red flag for investors. And it signals a few things. Whether one thing that it could signal is that people are not very excited or very confident in the current economy. They see maybe a recession coming down the way. Another potential reason why an inversion could happen is that they foresee a correction in inflation. They see that inflation will continue the downward slope. There's less incentive for the government to increase the yields later down for the longer term. So if it's a latter, it's good news. If it's the prior or the former, not so good news because we are facing down the barrel of a recession.
Yeah, so I mean, like this is like bonds and this part of the business has always been like a foreign language to me. It's not easy to understand conceptually. So like simply put, like everybody in the audience, think of it like a seesaw, right? When rates are high, values of them are low, and if the yield, not rates, the yields are high, it just means it's risky. Investors don't want those bonds at face value. You need to buy it under market to offset the risk, which is why the yields are so much higher. So because the yields are higher and they're going up, that means we're going to have higher mortgage rates. Because again, simply put, investors don't want to buy something that's risky at $100. They want it on sale, right? So it's like if I'm going to buy something from Target versus TJ Maxx, and it's a similar item, and I'm uncertain where my paycheck is going to be or my income's going to be, I'm just going to go to TJ Maxx and get it on sale. It might not be 100% of what I needed, exactly what I needed, but you know what? I feel safer spending $70 than $100. You know?
Right. And the reason why the two are related, mortgage rates and bond rates or bond yield, is because invest like what we talked about with Fannie and Freddie. Fannie and Freddie, they package a bunch of mortgages together, create something called a mortgage-backed security, sell it to the market, and the market will see, okay, this will yield some percentage of amount. It's going to guarantee me some percentage, which is people's mortgage payments, right? So if people's mortgage payments is less percentage-wise compared to a bond, a U.S. Treasury bond, when you look at the risk profiles and the return rate, they're going to pick the safer one, even though it has less potential for earning or for income. So for someone who feels like, oh, the economy is not going to go well, there's a recession, they're going to fly more towards a safer asset, which typically is the treasury bonds, right? And so the mortgage backed securities kind of have to compete with the treasury bonds. And that's why they're highly, highly correlated. And the bond market actually just sets the tone for every borrowing rate out there, whether it's hard financing, whether it's like bank financing, whether it's the mortgage financing. It's like the bottom level.
Mm-hmm.
Yeah. So we've been tracking it. We've been talking about it here and there on the podcast. But this is something that, if you're not aware of it, it's time to kind of start paying attention, especially if you are an investor, right? And you want to look down the road and see, okay, is this something that I should do now or something I should wait, something that I need to hurry up and get done?
Or just think of it as noise, and does that deal pencil out the way it needs to for your return on investment. So I'm telling you, there's a lot of people scared of the Florida market, but I have investors that are absolutely loving it right now. And they're just like
Mm-hmm.
going head first into it. They're like, I need cash now because there's deals here that are really amazing. And it's like I was talking to another customer yesterday about it in Florida, and they're like, it was just some of the most amazing deals that he's restructured. Like he's like doing property splits, took like a a duplex, and he's getting them split into two different properties, and that ended up going from like a $1.5 million acquisition to a $3 million split, 1.5 each. So it's like he
Mm-hmm.
doubled his money on certain deals, and he's doing it in like 12 months, 18 months. It's a longer project, not a quick fix and flip, but there's so many different creative ways in real estate. And I can tell you right now, he doesn't care what's happening to the bond market. He knows how to identify deals and opportunities. Again, same goes for if you're a first-time home buyer. It's like you can look and hear all this noise, but once you buy your house and you're able to know you're comfortable making that payment, that's your house. You don't care what the bond market does. It's like I'm making my $2,000 monthly mortgage payment, got a roof over my head, and it's my dream home or 90% there, right? You can't beat that. It's like you have to be able to make decisions where it's relevant to your goal. What is the main purpose behind? What is driving you to become a homeowner? What is driving you to become a real estate investor? Like if you're looking for quick wins, this stuff will wreck you easy. Simply put, don't build a deal around perfect rates because you want to build it around like your rate tolerance. You want to build it around your monthly payment. It's got to fit your buy box. It's got to fit your family's needs, right? And then you can book a call. We'll walk you through it. We'll filter and figure out exactly what it is that matters to you so you can make the best financial decision for you and your family.
You're not too concerned with what's going on in the bond market because if the bond market continues to deteriorate like this, rates
I've
are
never
probably going to go up.
Yes, it's going to go up or down, but it's like that's part of life. Like, what are you waiting for? It's like what you're waiting for the perfect opportunity to make a buying decision based on rate. That doesn't work. You'll never buy. You'll always wait forever. You'll be sitting on the sideline. So it's like I've paid attention. I've listened to the bond market. I've seen the news on it, but I've
Mm-hmm.
never in my mortgage career like stressed, oh my God, because of the bond market, we're not going to buy homes. I'm
Mm-hmm.
telling you, look at the data, dude. Look at the data we just published for Orange County. Does it look like it's slowing down because of the rates? I don't know, man. That's still $5 billion in sales in the month of May in real estate in Orange County.
Yeah. I think at this point, the prices are more important than the rate.
It's exactly. And because of the prices, or what it comes down to is, can I make that monthly payment? And am I going to be able to sustain that monthly payment over the next period of time that I'm thinking I'm going to keep this house? So it's like for the right customer, there's going to be the right house. And depending on the time, doesn't matter what the rate is. Am I going to be able to financially afford that home? And then is it something that makes sense to me, right? So again, it's just a matter of are you pricing as a seller of a home as a homeowner in Orange County? Are you pricing correctly? Do you have realistic expectations for your home? Realistically, are you really the best house on the street? Like you got to be realistic. And if you're not realistic, the market's telling you the buyers aren't going to buy your house at your unrealistic price. That's basically what they're saying if you're up there. And do you want to be that one seller that has your house up for 6 months and delist it and relist it and change agents 3 times? So you got to price accordingly. And again, the good houses, they sell fast at list or over. If
Mm-hmm.
you're unrealistically priced, yes, the buyers are going to tell you, no, I'm not going to buy it at that price. You're going to cut it. You're either going to cut it or give concessions. And that's what the market's showing.
All right. So the reason why I want to talk about this is because if we're afraid of the bond market and how it could potentially affect the mortgage rates, and we have a bearish, if people have a bearish outlook based on what we've been sharing, failed auctions and whatnot, and inversions, the potential plan to help offset those negative effects from the Trump administration is the Bitcoin Strategic Reserve. So initially, publicly, it's been pushed as a way to offset the balance sheet because, Bitcoin and gold, it's supposed to be able to appreciate in value, and they can do some like weird accounting tricks to increase the asset side of the balance sheet in order to, to even out the liability side. But what I've been hearing through analysts and whatnot is that we could potentially be able, the United States could potentially be able to borrow against hard assets like it used to back in the 70s or pre-Nixon, right? So if the world is looking at the US dollar as not so stable, not so strong, and they're devaluing it, and we see that reflected in the bond market, if there's something like gold or Bitcoin, and we leverage that and borrow against that, we could potentially see improvements in the economy without wrecking our deficit and without wrecking our interest payments. Because the interest on a hard asset could be very low compared to interest on fiat currency, which is how, why we talk about consolidate your credit card debt with a HELOC, right? Because
Mm-hmm.
the interest rate on a hard asset, collateralized loan, is way better than just
Like an
I
unsecured
IOU.
personal loan. Mm-hmm.
Yeah, yeah.
Basically, that's basically it. It's an IOU with the personal loan or credit cards.
I promise to pay you
I
back, partner.
promise. I promise. One day, buy now, never pay. What was it?
Yeah,
Buy now, pay later. Sorry.
buy now, pay never. But yeah, I mean, this is kind of exciting. I'm really excited for it, and it just goes to show you that in this country, the way it's set up, the only way to get ahead of inflation, the only way to get out ahead is to own assets. So if you are on the sideline, I know we talk about this all the time, every video, and we may be biased because we are mortgage brokers. Um, you know, owning assets, whether it's stocks, whether it's Bitcoin, whether it's a home, these are the ways to protect yourself, to insulate yourself from eroding your wealth from inflation or because of inflation, I guess.
Yeah, no, and at the end of the day, it's the roof over your head, right? And your family. So it's like, to me, it's like, I look at it as, man, I can't wait to retire and have this house fully paid off and just enjoy my golden years with my
Hmm.
wife and kids,
Yeah,
and grandkids one day.
absolutely. That's all we got for today. A lot of noise out there again. You hear potential recession, going back to '08 crisis or whatever, whatever. A lot of it's just noise. A lot of it is to get clicks.
It's a big distraction out there. It's like we're not gonna get Bitcoin mortgages tomorrow. Like, but
No,
it's
Dubai is.
it yeah, but it's like we're not. That's realistically not gonna happen tomorrow. Like it's just like MBS is, right? It's not Bitcoin MBS BMBS, But again, big shifts in finance don't happen all at once. They do build up over time, and everything like what we talked about can impact over a period of time, like what the landscape could look like. Privatization of Fannie, like we spoke about, AI, bond market shakiness, like an alternative like capital models, just like Peter loves, which is crypto and DeFi and everything not what I grew up with. So that's the difference, right? Oh, and one thing that I wish we did talk about was with AI, because man, like I'm like the more I research into it, it's not like there's different generational uses of AI, right? Like boomers, it's a replacement for Google. Gen Z, it's like a tool. And then like Gen whatever the one behind that, they're using it like an operating system where they're utilizing or creating prompts where it's asking for like decision trees on how to enhance their next product, like next decisions.
Interesting.
That's interesting to me. Like that use case as an operating system, as an AI, that's where it becomes real, like of an assistive technology, not just a input output results model. AI,
Well,
like this, it
yeah.
becomes more sophisticated. Huh?
Uh-huh. I'm very interested in the agentive use case of AI. So like AI agents, you know,
Mhm.
and it's also very scary because that could mean a lot of people are going to be out of jobs. But that's a topic for
It
a
should
different
be.
episode.
It should be. That means less noise. But those agents, AI agents, will only be as good as the inputs that design them. So it'll. Will it replace you, Peter? Will it replace me? I hope so one
Maybe.
day. But I
Maybe
think
I'm
for
AI
now,
agent on VO3. You'll never know. They're so good now.
I know, right? Like AI video people from last year, it was so
Uh-huh.
obvious it was AI. But some
But
of the
now
stuff
it's
now,
real
it's like
tough.
you can't even
Yeah,
tell.
it's so
So it's
crazy.
pretty crazy. It's pretty crazy. I think 2050 in 25 years, AI is going to be it's going to be considered an assistive technology, 100%. It's
I
going to be more
Jason, I don't
integrated.
even think it's gonna take that long. I think 2026 we'll be blown away with how fast AI has taken over a lot of
It's already been
jobs.
3 years, Peter.
Only been 3 years, but
It's
AI
already been three
processing power
years.
doubles every 6 months. Every
Moore's
six
law, brother.
months,
There's not enough
processing power
energy to
doubles.
double. It does, but then it's like it's technology. It's like computer chips. It's called Moore's law. There's a point where you can't double anymore, and there's not enough energy, which is why Elon is doing what he's doing with all those batteries and
Bro,
energy.
they are okay. They've already have 0 point energy figured out. They just haven't released it to the public yet. Okay, uh,
I'm sorry, I
so
don't know what 0 point energy is. That just went.
it's energy that you get from just space.
Okay, no, they did not. We're not in the Dyson sphere.
All right, we'll dig deeper into 0 point energy next time, and then I'll go get taken away by the CIA. All right. Remember, there's a lot of noise out there. Continue to stay patient, do your research, and stay informed with the right type of content. Our aim is to bring you guys valuable and unique perspectives on each and every video we put out. All right, we'll see you guys in the next one. Bye bye.